Session 3 is what stocks to buy. So we're going to look at what is a stock, how to pick stocks, and we're going to talk about index funds and the type of index funds and what they are. So what is a stock? A stock is a ownership of a company. So you become a shareholder of a company. And you can see this example from one of the stock holdings I have of Civitas Social. And I've got 13 shares. So I own a piece of that company. Now, why would I want to own a stock and what's so important about them? Companies make up the economy. If the economy does well, you do well. So if companies do well, you do well, especially if you're a shareholder. Now, what may increase a stock's value? So if they increase the revenue, if they're making more money, if they're making more profit, if they develop a new product, and there's so many other variables that can be included in here. But I wanted to try and keep it nice and simple. It's like me owning a Rolex. So let's say I bought a Rolex of £5,000 and I sell it in 20 years time. That Rolex potentially could be worth £20,000 because it's limited supply. So same as stock, there's a limited amount of stocks. The more people that want the stock, that drives up the price of that stock. And if you're a shareholder of the company or you hold some of that stock, you hold that value. So how do you go about picking stocks? And I'll give you an example of how individual stock picking can be so powerful and you could have made a lot of money. So if you invested $1,000 in Amazon 10 years ago, that $1,000 investment would be worth $11,891. So you would have made more than 1,000% increase, or an annualized return of 28%, which is ridiculous. This is Apple 10 years ago. So if you invested $1,000 in Apple, you would have made a profit of just over $7,000, or a total increase of over 600%. So imagine if you put $10,000 in, you'd have $77,000. This is $1,000 in Tesla 10 years ago. You would have got a total increase over 15,000%, or that $1,000 investment would be $153,000. Now, this is incredibly difficult to do. Think about it. If you're investing yourself as an individual investor, yes, you can find gems. I found a couple of gems. I bought an electric Chinese car maker called NIO at $4. Now it's trading about $18. It got to about $40. Which was ridiculous. So yes, you can find those gems. However, it's very difficult to do. And investing companies spend millions of pounds, have 1,000 employees to find these gems. So you as a single person doing this is going to be very difficult. However, there is an easier way, and we get onto index funds. So an index fund is basically a basket of shares. They've compiled loads of different companies together, and you can buy a share of all those companies. So the key benefits of index funds, they lower your risk and increase your diversification. So you're diversified. All your money is not in one or two companies, it's in hundreds, if not thousands of companies. They have a very low expense ratio. We'll look at that later on what that means. Strong returns, and it's ideal for passive buy and hold investors. So if you're beginning, all you have to do is put money in and that's it. And the stock market will run itself. You don't need to do anything. You don't need to buy anything. You don't need to sell anything. We get on to one of the best and most well-known index funds, the S&P 500. This is by Vanguard, but loads of our companies do it. BlackRock do it, and many, many others you'll see. So the S&P 500 is the top 500 companies in the US. You can see here, it's roughly around 503 stocks. And the ongoing charge, so Vanguard are doing the buying and selling for you. They're making sure your investments are doing well. They charge a very low fee of 0.07%, which is next to nothing basically. Now, instead of buying individual stocks, the S&P 500 is top 500 companies. So these are the top 10 holdings of the S&P 500. You can see Apple's at the top. They got about 7%. It is one of the biggest companies in the world. Microsoft, Amazon, Tesla, Alphabet, Berkshire Hathaway, United Health Group, Johnson & Johnson, Nvidia Corp, and many, many other companies. So you're not just focused on one company, because if one company tanks, that's all your money gone. Whereas if, let's say, Tesla tanks, you still got all the other companies to hold up your portfolio and hold up your investments. This is why the S&P 500 is known essentially as a stock market. It doesn't fail because there's just too many companies involved, and really good companies. So we saw this in a previous session. The annualized return is 11.82% for the last 90 years. However, that is quite a long distance. There's been world wars, there's been crazy stuff going on, many other wars as well between that time. If we look at the annualized return since 2008, because I said 2008 was a big change in finance and investing, the annualized return is actually 16.54%. So much higher than the last 90 years. So from the figures we done earlier, you would get a much better rate if it's compounded across. This is another example of an index, or what we call an ETF, exchange traded fund. It's called the iShares Clean Energy ETF. This ETF have about 95 companies, and it's all into clean energy, solar, wind, hydrogen, biofuels, that sort of stuff, because I think the future is going that way. So I've invested heavily in this index fund, and this is run by BlackRock. And there's many other options out there.